let's jump into our top 5 trends in commercial real estate. So we're going to be covering 3 major topics, some of the wildest, most unique commercial real estate related stories out there. So we're hoping that you can learn, educate, and implement this into your marketplace, whether you're a broker, property owner, or somebody that's interested in jumping into real estate. Let's cover some stories. We're going to dive into it right now. What's groundbreaking in CRE? So, first things first, we need to understand that buildings are selling for $1. Shocker. I know. I'm thinking the same thing. What are you talking about, Bruce? How are buildings selling for $1? Well, I'll unpack that and I'll give you a case study around that. Second, guys, Manhattan's a big buzzword. We're all over talking about Mamdani and all of these buildings and what's going to happen with development, right? Yeah, yikes. If you're an investment group over there, Manhattan's turning offices into luxury apartments nobody can afford. We're going to unpack that. And then third, the U.S. government's overpaying for warehouses. Think about this. The warehouse sector, I've been talking about it for a while, it's skyrocketing. And what's happening? The U.S. government jumping in. They want to get their tentacles in. They're buying this land and they're paying above market value. So if you don't understand this shift, you're already behind. And I'm talking way behind. So let's lock in today and start with buildings selling for $1. The $1 office building story. Now, this is a true story.
I think we're good. I'm just gonna turn do not disturb on. All right, we're good.
We're back at it. So this is us improving. We're going to turn on Do Not Disturb on the next go around here with that. Anyway, things happen, right? We're going to keep moving. What does that mean? Real life case study, guys. An office building sold for $1. I understand this is hard to believe, right? I'm in skepticism mode as well. But what you need to understand is why and strategy. Because here we are. We had a dramatic value collapse on this building. The office tower now selling $1 and a drop in valuation from $24 and $19 million. Guys, what does that mean? It means that because you can't even give the product away, it's such a tax to have to reposition to maintain the taxes, the insurance, and all the OPEX costs, that the building itself is virtually worth nothing. It's crazy to understand that. Now, in logistical terms, I look at this and I start saying, guys, the replacement cost of the building is what I would jump into. How much does it take to even replace this? Now, can you retrofit it? Is there ways to save it, similar to what we've done with Jason and I in Grand Street, where you retrofit an existing building because you got basically the skeleton, so to speak, to work with? That's what I'm thinking right now. Why are people not getting better advice around it? So market shifting, this represents a significant decline in property values with commercial real estate. Yeah, no shit. If you have a building where the replacement value is so much more than what you're selling it for, you better have a strategy behind it. That's why I encourage you to check out this article and see what their strategy was around this. It's going to blow your mind. Now, tax burdens. Think of the collapse of commercial shifts as being a big tax burden. Why? Because these buildings used to produce a lot of revenue to the municipalities. Now, all of a sudden, this building that was operating, paying taxes, goes into a position where it doesn't support itself any longer. And these are tough situations. And big investment groups have to make serious decisions. And mom and pops, you and I in this marketplace, if it's a smaller office building, and let's say it's a couple of $1 million, right now we're in positions where we're selling them. People don't want to lease them for the prior prices in our minds. $40, $45 a foot, now it's $20, $25 a foot. They start getting lopsided, and you have to look for opportunity. If you don't, these things sink like anchors. And if you do, and you can untap some dirt to dollars or an income and expense valuation that's appropriate, you can get yourself out. Cost opportunity of that money is what I'm looking at for all of you guys. Know the cost opportunity and see where it is. Is it better placed right there, or should you jump ship and go into a new asset that can climb quicker than that one? Get back to at least the baseline for you to get going. Now, fundamental repricing. It's not temporary market dips. It's fundamental lasting repricing. What happens when the office tower goes out and a new townhouse community goes in? Well, the new tax incentive for that community is being paid to municipalities, so they're happy to see that. Now, if it's appropriate in the community, everybody's happy to see it. But what you don't see is a vacant office building that is boarded up with wood that becomes a liability in the neighborhood for people that are looking at doing bad things. They get spray painted on, and everybody knows them. You see them in your community. I know I certainly do. I'm not proud of them. So what do we have to do? We have to encourage strategy in terms of value. And that's where the $1 office building should never be sold unless you knew the strategy behind it. Now, moving ahead to the office crisis of where we are. Our rewired takeaways from where this office building would sell would be one, reposition. If we're looking at it right now, we're going through it with sellers where we have an opportunity to develop and it's at a better price, but the length of time that it takes, the 6 to 12 months, because of bureaucratic politics in the approval process, doesn't allow that seller to untap that because they've got a motivation that's more time sensitive. So think about that. That devalues the asset. Plain and simple. So we're seeing rapid devaluation. Office properties are experiencing sharp declines in the market. And that's what everybody is seeing and we're feeling right now. As a seller in this marketplace, seek add value. Seek understanding of what the dirt to dollars or the potential to reposition it is so that you can save on that property or maybe maximize the value in the marketplace. Certainly something that we would encourage at ERG. We look to maximize value with the 3-step process, which is going to be your price per square foot, your income and expense, and our dirt to dollars trademark name, which allows that development potential. Use it, execute it, employ it. Because if you're not, you're leaving money on the table. And if you are, well, at least you have an honest opinion towards the marketplace and you can make the right decisions based on the right options. The most accurate truth from very believable people. Urban economic impact. Guys, cities face significant losses in tax revenue due to the decreased commercial property values. If the property is going down, so is the taxes. Plain and simple. If I own a building, it's $1 million, and then the town comes back to me and they start telling me it's worth $700,000 or $800,000. Well, I'm not going to be upset about the taxes I don't have to pay on that $700,000 or $800,000. But if the building I'm paying taxes on is $1.5 million and the market value is $700,000, well, then I'm paying twice the amount of taxes. And I'm going to go hit that government and say, hey, I need an appeal on my taxes because the value is actually associated with this, describe comp 1, 2, 3, etc. And then you have reasoning. What does it do for the town? Less money. You have less revenue coming in. So it has less employees. It has less asphalt paving for all the potholes. School systems maybe don't get the best textbooks next year. These are real life examples of what happens. So urban economic impact is something I would definitely jump into understanding what an office crisis is. Investor opportunities, investors are seeking distressed offices. Now, why would they want? Because look at what we're doing. You're selling a distressed office that's vacant, and if you don't have strategy around that, well, you're gonna get on a price per square foot at the lowest amount from the investors. So if you see those deals trading and you wonder, how the heck did they do it at 3 times the price per square foot? It's because they didn't use that metric. They used an income and expense, probably leased it out, probably got a much higher price per square foot. Now, think of it in layman's sense. I'm talking to my daughter, Blake. Blake, if you bought a building and all of a sudden you can put a tenant in it and they pay money, and all of a sudden that building's now worth 2 times the amount, does that sound like something that you want to be involved in? Yes, Dad. So everyone out there, same thing. You should be thinking the exact same thing. If not, you're not building your wealth through real estate. You're just being silly with your money and your options. So office properties are experiencing a sharp decline in market value, impacting urban economies through tax revenue losses. However, the present opportunity for investors seeking distress is there if you find them. If motivation is there in a seller and they want to sell and it's in alignment with the buyer and those terms work, why wouldn't they sell? I'm just giving you avenues to explore, moles to whack as you're going through this because it's all real life and it's all realistic. There's no one right answer. There's multiple different factors that can affect. So moving onward, biggest wealth reset right now is going on in CRV. It's in history. If a $24 million building can go to $1 and sell, what can your property go to? I would have probably said that chances are very low on something like this ever to happen, but it did. And the strategy behind it is where you will untap the potential that you have. Because here's the deal. If
encouraging you on looking into that and what that looks like. Understand the profound impact of market shifts, evolving work models on office valuations. Because a lot of that big WeWork and all of the Upworks that came in struggled. A lot of people had that initial concept. It was really cool and exciting. Where's the business model behind it? If it really works, we'll see it happen in the next 12, 24, 36 months. Story number 2. This one gets me, and it's something that's real close to home because we're looking at the GWB right behind us over here in Manhattan, and that's the first stop right here from New Jersey. We go to New York, and New York comes to New Jersey. Well, more we go to New York. Manhattan's luxury conversions. It's the dilemma and a solution for everybody as it goes around. Look at the beautiful skyline. Now, the challenges that we're facing is that New York City is facing high office vacancy alongside a critical housing shortage. And Downey has gotten everybody, their panties are all in a bunch, so to speak, because everyone's trying to figure out what to do. And if you use the certain ordinances that are passed to your advantage, then it may work, but it's costing a lot of money and a lot of resources to be able to understand how to unpack this. So a solution that we have is to convert obsolete office buildings into residential units, focusing on Midtown. When you start looking at these, those towers are going out, we can focus on expanding housing. The housing's already built, so the retrofit should be a little less costly than putting up those buildings in a lot less time. So if you can afford some developer incentives to go into there and make those units at market rate, but just in that affordability character with a certain component, 15, 20%, I think it's a great solution and it could scale over 26,000 residential units that are planned for conversion. So bravo in terms of that. However, with what's going on with Mamdani and these laws with real estate development, I think that there's going to get some handcuffs on all of those rules and regs, and I think ultimately it's going to stall. We'll see what happens with midterms and as things unfold in the future of the city. However, Housing's address certain office vacancies. The high rents, 35 to 6,000 plus, primarily serve the luxury market. So when it goes into it, it's not like we're talking fair market value for maybe your neighborhood or et cetera. We're talking fair market value for Manhattan, which is big, 3,500 to 6,000 plus. So it's widening the affordability gap between the low and the high earners and the midtown New Yorkers. What it does provide us is some stability within reason, because if we can start converting these in the face of adversity and building new developments, you're doing the same thing, just different, right? So if the cost works, you're still swinging the hammer in the building, you're still putting another butt in the seat, and a person in a bed, and that's it, it's just different. Moving onward, my takeaways from this residential squeeze are as follows. Developer focus, prioritizing the luxury market segments for higher profit margins. Guys, if we're going out there, I'm seeing certain luxury properties that are crushing it. If you can get a certain branding in this marketplace where you have luxury taste and it gets known to everybody and you become a product they come after, I've seen that be very successful. And it's great because you can see hotels and conversions that go into those that sell that lifestyle of what it is, and then they incorporate it into your housing. I think that's a huge focus. And Manhattan's got that nailed because you got to go up. Where are you going? You ain't going outward. So I think they know how to efficiently put amenities in these buildings and make it flow well, which if a developer focuses on, especially in those luxury markets, they're going to see that. They'll get the profits on there because there is a lot of money in this marketplace. However, people are cost conscious. They're not just because they have money going to spend it. You got to show the value. If you show uniqueness, and you show advancement in technology, and you show luxury, more hotel-driven atmosphere and aesthetics, probably going to knock it out of the park. That's what our trends are saying. In the middle class squeeze, we're seeing limited availability or affordability in the mid-range. I think it's common for every one of us to have that mid-range squeeze, so to speak, because developers aren't building in that mid-range most of the time. They're building more in the higher end. So when we see that scale, Horton, Pulte, Toll Brothers, when you see that scale, sometimes you do get those mid-level, communities where, they're typically building $900,000 properties. Let's say they do $300,000 or $400,000 properties. I've seen that happen. They pay different in terms of the approvals and all of the economics around it. But if they can get projects like that, they will build them. It's just harder to align with sellers and buyers, but once that's the case. High conversion costs, significant expenses in development, the land construction, and the land regulations. basically necessitates premium pricing to ensure profitability. So what we look to do, especially with Charlie, is be able to bring in the economics of a lower density project that meet the same economics of what the community wants, as well as what the developer costs are to build and maintain that as a profitable project, a feather in the cap for the community. So those things we seek to unpack solutions alongside. We need great people, awesome people like you to be able to bring projects to us, to be able to sell these projects with confidence. This way we advance our neighborhoods and we get these communities, our baby boomer generations, better product and housing, along with our millennials and everyone below that's gonna need this product as it comes. With advancing AI and technology into housing, I'm super excited to see what it is, and that's a big residential squeeze takeaway that I have. So, fixed office vacancy, but they created a luxury only city. And that's exactly where we're seeing Manhattan. It's basically become one of those where in the daytime, so many people come. And then in the night, once the workday's over, a lot of people vacate out. And you see that because not everyone's living there. They just don't have the amount of money it takes to be able to live there. And that's why you see everybody go to the boroughs. Story number 3, Adam, where are we at? We'll breeze through 2 stories. How we feeling this morning?
Good.
So far, so good.
Yeah, loving it.
Ready for story number 3?
I am.
All right, we're talking about government. This should be an interesting one, especially when it comes to government, because when they're coming into town, they want to buy product. Pretty serious on the go. So
Yeah.
let's see what they have. The government has fueled industrial demand. ICE acquisitions impacting real estate. So when we start understanding where the marketplace is, we start understanding ICE has been a big word, right? A lot of people talking about these things. ICE warehouse purchases. U.S. Immigration and Customs Enforcement actively acquiring warehouses nationwide. What does that look like? It means the government needs to build their infrastructure, their real estate portfolio, so they're going into marketplaces and they're overpaying for properties. I'm saying it again, they're overpaying for properties. Why? Because they need them in certain areas. So if you're a property owner, if you're across this United States or northern New Jersey or anywhere around and you see an opportunity to align with the government, then maybe chances are you get a bigger payday. Who knows? But again, strategy driven down. Just like we were talking about office buildings. If you don't have a strategy, you're not tapping the highest value. Second, above market value offers. Properties are being secured at prices up to 27% higher than market value. You heard it right. I'm not describing this as something that's not happening. It's 27% above market rate. These are stats right from CoStar, right from our network that are indicating, guys, if you can get yourself into a situation where you have that, explore that opportunity. Explore that opportunity. Explore that opportunity. So detainee housing capacity, guys, they're also buying these facilities for all detainees and just increasing our security throughout the United States. Acquisitions are intended to house over 92,000 detainees. Now, this is going to help take the people that are hurting all of us good people out here in the United States and put them away with the theory that if you're doing bad, you get caught and detained, eventually you just get out of the system. That's what we're promoting. We want good here. We want people that are growing communities, they're growing the economy, they're being nice to their neighbors. We got that golden rule effect. I think our society would be a much better place with that, and I'm here to expand that and maybe encourage everybody alongside you to do your part within this. So, artificial market inflation, where we see that with the government then? Government-driven demands artificially inflating that. So if you get a comp or you see an industrial property that's sold for buku bucks, I'm talking buku bucks, and the numbers don't jive, sit back, scratch your head, and look at the buyer was. Because certain people, they're going to overpay because they need certain locations. So if you're a seller, if you found a location that somebody would absolutely need in your marketplace, maybe you can put 2 together. You put the tenant in there, buy it, boom. Maybe you own the property, you can find somebody, finance the building. There's so many strategies that you can deploy to build your wealth and to create more in your portfolio. Community concerns around this significant local pushback and community concerns are rising due to these because what's feared is the unknown, plain and simple. I think if you don't know what's going on, you fear it and you want to object to it because ultimately you're just seeking an understanding. It's not really actually necessarily opposed to it. A lot of times when we have conflicts between people, etc., deals, it's misunderstanding more than it is, personal misunderstanding of what it is. So we try to get to the facts. If it's gonna help out, it's gonna do this to the community, this is where it's at. Everyone's allowed to have their opinion, and their personal opinions around this are encouraged, because glad they expressed that they should be able to. It's just, what is the best situation? Because if it hurts one and helps 100, what do we do? And what if that helps 1,000,000 and hurts one? It's these big decisions that politicians are making for us all, so we're gonna encourage building good communities within it to help them make better choices. So government-driven demands artificially boosting real estate, leading to significant local pushback, community concerns. That's what we're seeing. So if you see those buildings being bought in your neighborhood or on the outskirts of the suburbs, where all of a sudden, boom, new building, that could be what is going on right there. Now, the evolving industrial boom is beyond logistics. It's into brand new brands. What does that mean? It means if you have a building, you can do that, untap it. We've got the contacts here at ERG to make it happen for you. We're expanding into different municipalities to be able to untap those industrial dollars and connect the dots between what the town needs and what our communities need, and our team of neighborhood family friends. Moving ahead, the US government just became one of the hottest industrial buyers overnight. That's what we're seeing. Those are buzzwords in the community, stories in the neighborhoods, and that's what we're seeing in real time. So moving onward, CRB's three worlds, the big picture. So concluding and running through what we did today, which is a fundamental split in the commercial real estate world. The three stories today, which is office, it's collapsing and undergoing repurposing. Don't need the $24 million to $1 unless you have a strategy. If you do, then you can shock them, because maybe that building's then worth $100 million. And that's what we encourage. Residential, growing, but skewed towards luxury. Skewed. If we had better incentives towards making it a package towards the middle, where everything was still viable from the nationals, regionals, and locals, could be a great solution. In the industrial, it's exploding with unexpected demand, right? We're including government intervention with these properties being purchased and giving a higher number to them what they actually should be selling for. Great way to get a little bit extra on your property. Now, these three stories reveal a fundamental shift in commercial real estate. So top in each week as we uncover the top three wildest, most unique commercial real estate stories, and we dive in with our reaction and how this can help you and your business grow as a property owner, as a broker, as a residential agent, learning, trying to get into commercial. We encourage it because we were those people. I started as a lease, doing the groundwork on everything, ultimately wanting to grow into multi-million-dollar sales and impact our community at the highest level. Want to be around the business owners that are making these big decisions and help advance these communities. So if you're on track for that mission, and you like what you hear, contact us, ERG, Trelia. We'd love to help you guys out, give you our 3-step valuation and that price per square foot, our income and expense, and our dirt to dollars trademark specialty, which we focus on to untap those extra dollars for you. That is Real Estate Rewired.
Can we do,
Adam,
can
what do
we
we
do
have today?
reaction videos where you react to the video I pull up? I have videos prepared.
Yeah, what do you got? Let's do it.
Can you just disconnect from the TV?
Okay.
Yeah, just go click that and then click that.
Yeah, it's not on.
Yeah, it still shows it's connected. If you turn around, it's
I'm not sure what to do. I'm listening, saying it's not connected.
here. Just give me your laptop. Maybe click the one on the left. Yeah, there we go.
Good.
Looks like it disconnected.
Okay, good.
All right, just be patient for a sec.
Well, because I needed to change.
The thumbnails look great.
Oh yeah. All right, so this is the first reaction video.
Am I watching this video?
Yeah, you turn around. I have it pulled up.
The other buy.
We get the audio going. Oh yeah, the audio's not working.
To give it our foot.
Oh, there we go.
I own 15,000 houses.
15,000 houses.
Okay.
We should give it our foot.
Nothing wrong with buying a house. Yeah. Since I use debt to buy it.
Okay.
And I pay no taxes. It's not the house, it's not the stock, it's not the bond, it's your brains. In 1971, this became debt.
Okay.
The only way it's created is somebody has to borrow money. So in your credit card, there's no money in your credit card.
Right.
There's no money anywhere. So the moment you use your credit card, money is created. And they need people to borrow money. So when I go to a bank and I say I want to borrow $20 million, I get huge tax breaks because I'm creating money. But if I use my credit card, I get nothing. I own 50.
What do you think about that opinion?
I think he's absolutely right. You create money once you spend that versus the opposite side. And I think that he's got great insight in terms of what his structure is in terms of purchasing. Because when he looks at it from that perspective, he's refinancing these buildings and he's taking the equity that he has and not paying tax on that. That's a really smart way, in a way that you can own buildings in cash and refinance out and take equity that's converted into cash to be able to put into marketplace. His description is that the credit card that you pay is actually generating business because the service providers and the banking and everyone behind it is making money, which is accurate. In that same sense, you're paying tax on it. In the other context, what he's describing is a way that he purchases things outside of it using the debt that he has and the equity ratios. It's an interesting reaction video, and Robert Kiyosaki is one of the legends in real estate. The way they use his portfolio streams.
All right, you ready for the next one?
Do you have any advice? But I don't think it's gonna make its way into next year. This is, kind of why I'm really bullish on buying right now, because real estate in a lot of ways is getting beat up. These crash bros, these YouTube crash, whatever you wanna call them. It's interesting to me, they're doing that, because it's actually a little bit of a benefit, to me, when they're signaling that. It's like it's a great time to buy, but I don't think it's gonna make its way into that.
What do you think about that? Great time to buy.
I love his shirt. Great State Golf. I was looking at that for a second. I agree with that. Everything that he was saying, just because it's always a good time to buy, guys. When I started my real estate career 15 years ago, in terms of context, everything that you purchased would make you not have to work again today if you were able to do that. So I encourage it because you buy now, you hold it, later on it's worth a lot more. The tenants pay down the debt and ultimately create a big gap of that equity that you can convert into cash. If you go into the next step, which is sell it and want to pay a tax deferred exchange with 1031 to not pay the capital gains, you go into the next asset, you purchase it at the same amount, if not higher, with some guardrails around 45-day isolation period and 6-month closing. I think this is genius. I think you buy as much as you can, as often as you can, and here's the trick. Get as much leverage as you could. The higher form of cash on cash is if you put a lower down payment, i.e. you buy a property $1 million. If I bought it for $1 million in cash and that property went up to $1.2 million, I literally just made 20%. But if I put $100,000 down and I bought a $1 million property and the $1 million property went to 1.2 million, I just doubled my investment because I had $100,000 in cash. I had $200,000 of appreciation. Do you get the math on why that's the case? That's where leverage comes in. So if you can buy right, hold it, you're going to be rewarded later. That's a great CRE tip. Simple as it comes.
All right, this is a guy just giving general.
You said
But I don't think it's gonna. Do you have any advice for anyone that wants to get into commercial real estate?
making calls and being persistent, which is really any job. You just have to work really, really hard and make a lot of calls. You make calls and it's not as hard. If you don't make calls, it's very difficult.
Do you have any advice for anyone?
This guy's the best. This guy's made so many calls that he's just got his sunglasses and hair flowing right now that he's like, I'm He's obviously made it, and there's no trick in any of this. It's probably, this guy might have made a million calls. I know that at PhD Capital from way back when in 5 Hanover Square, we were a minimum of 450 dials a day. Think about that. We got in our office at 6 a.m. and worked until 6 p.m. At Jody and Nelson, the entire crew started me off in understanding what work ethic is. Because let me tell you, the way that that city vibes at 6 and 7 in the morning till 6 and 7 at night with work and really high intense level is amazing. So what is this guy suggesting doing? I take it as put your butt into a seat and dial the phone if you're in commercial real estate. And if not, put your butt in the seat in Starbucks, put something on your computer screen that says I'm a real estate broker and I can help you because you need to talk to people. My dad always tells me, Bruce, real estate is a contact sport. We're football players, so I like contact and I'm all about it, but not in that context. It's contacts, and that's what we need. So asking them, making calls, I couldn't agree more. I think this is essential for any business that you're doing, prospecting and marketing.
So do you think quality over quantity in terms of calls?
I think that the quality is in the quantity. So I think the quality is in the quantity. And that's what we practice here. Gary Keller reads from the helm in terms of Keller Williams with saying that as much quantity as you get, quality filters in. It's our ability to attract and scrub and filter that we can then use those clients and filter out the ones that don't hit our goals. I think this is great. The guy is even more hilarious in this than anything. He's so chill and hung out, and he's definitely been there and done it.
Yeah, like let's play this one again just to look at this
Yeah,
guy.
just
Anyone that wants to get into commercial real estate.
Making calls and being persistent, which is really any job. You just have to work really, really hard and make a lot of calls. You make calls and it's not as hard if you don't make calls.
It's as simple
He
as
looks
that.
like he just played around at golf.
He may have, yeah.
Yeah.
The thing is that nobody sees the earlier. Telling his personality, he's so calm and relaxed in the way he's describing this. To me, he's been there and done that, and he probably wishes he did it sooner too.
Yeah,
Like a lot of us,
absolutely.
You find something out, and all of a sudden you wish you did it sooner.
Yep.
What is New York City without its skyline? Monuments to commerce standing proudly shoulder to shoulder. More office space than any city in the world. But peek inside all this vertical real estate, and there's a fundamental question. Where is everyone? More than 95 million square feet of New York office space currently unoccupied. The equivalent of 30 Empire State Buildings.
This building had a lot of law firms, had some government tenants, so
Scott Reckler is CEO of RXR, a New York real estate company with more than $20 billion in holdings. We walked through his property at 61 Broadway near Wall Street. Every other floor, half the building lies empty.
I think this is an existential moment, I call it crossing the chasm.
What's the chasm specifically?
This post-COVID world of higher interest rates, the changing nature of how people work and live. We're not going back to where we were. It's a different world, and it's going to be turbulent.
It already is. What is new?
Wow, isn't this exactly what we were just talking about? We're changing the streetscape in these office buildings that are vacant. They're going on all across it. It's not just your city, it's our city, and it's New York City, the biggest city in the world. If they're being affected with 95 million square feet, what's our local community being affected by? Probably very similar, just on our scale. Maybe it's not 95 million, but maybe it's 1 million, 19 million. This is unreal. What you're seeing is a huge shift change. If these buildings can be converted into strategies that work for residential and from new age living, maybe condo and hotel conversions, amenities for the residential tenants as if it's hotel, having all of those ancillaries could be the solution, because those luxury markets in New York surge and it has the money. It doesn't have a brand building where it goes. So the brand buildings that have those attached, everyone flocks to pretty quickly and it gets the buzz. It's the word of mouth when you're at the parties and describing where you are, the new town where that's going. That's what we've seen. So when you see this, you may just see the office building that turns into one of the sexiest residential hotel condo conversions. There may even have an adaptability of rentals, condos, office, and hotel in one, because the strategy would be to maximize the amount that you need. Instead of a giant office building, maybe use it and break it down into what's applicable for the age right now. That's what's happening in New York. You're going to see those buildings win. I think that CEO knows what he's talking about.
Commercial real estate is $4 trillion in outstanding debt, okay? Single family is 13 trillion. Okay, so single family much bigger than commercial, and half of commercial is multi. So you have only $2 trillion of debt outstanding to office buildings, retail, all of that, hospitality, and you have $2 trillion out to residential.
And you operate mostly in multifamily, a lot,
Correct.
right?
And 50% of that $2 trillion is with Fannie and Freddie. The issue about housing is that people need somewhere to live. They may not go to the office, they may not go to the mall, but they are going to pay their rent. Okay, so multi is held up particularly well, and multi has the great advantage of when banks might not have been lending or CMBS lenders might not have been lending, Fannie and Freddie are always in the market. Commercial real estate is.
He knows what he's talking about. He hit it right on the head. Guys, I learned this early on. My father taught me this. Bruce, everybody needs a place to live, and not always going to need a place to work. I said, okay, let me understand what this means. It means if they themselves single, girlfriend, married, family, whatever it is, they're going to pay for their housing before they go open up a business and pay for their rent in the commercial space. This is common sense at its finest. If you're seeing a constriction in that, it's because people are looking at the higher increased residential rents and mortgages with the taxes and insurance, making these numbers much larger than they were even 3, 4, 5 years ago. These numbers are drastic. So instead of opening up the business with that difference in money, let's say, i.e., real life example, your $4,000 mortgage that you were paying 4 years ago is now $8,000. Now, if you had $4,000, maybe you had a rental for a new startup business at $2,000 or $3,000. You had some other economies where you can flow some money towards. Now the money's run dry. You don't have access to do additional businesses or open up it or quit your job and start that one. A little bit more risk adverse instead. And that's what he's describing, which is why the multifamily is half of that $2 trillion, which is a very secure asset. Because most people are going to pay the rent, pay their mortgage before they're going to pay the office, the industrial, et cetera, on the business end. Because they want to make sure that they have a place to live. So his bet, probably pretty accurate. I still see it as an opportunity where you can still create more residential housing that fits it. You're never going to have enough because we're shortage right now, 500,000 at least from what we're being told.
All right, this is the last one.
I think there's really two big misconceptions about listed REITs. First of all, that they don't have strong balance sheets. They do have strong balance sheets. LTVs, loan to values are less than 35%. We focus on that a lot. The second point is that office, which dominates a lot of media headlines, is a big portion of listed REITs. They're only around 3% of the REIT market cap. There are around 18 different subsectors within the listed REIT umbrella. What do we like? We like things like data centers right now. We think data centers are going through a huge growth boom, driven at least partially by AI. We're big believers in single family rentals. There's not enough housing in the United States. Buying a home is really expensive. Renting a home is not too cheap as well. So we like single family rentals. We like things like seniors housing. And believe it or not, we like high quality owners of regional malls as well. I think there's really.
Yeah, REITs are great. Focus on the fact that they have a 65-35 LTV. That's where it's noise to signal. That's a very healthy LTV. When they start looking at what they're growing and how they've grown year over year, proven business models, these REITs are great candidates for investors to get into. They're great returns on a macro level. Very thankful that we can have large scale operations, be able to jump in and do this at large scale. Because as you have smaller operations, you couldn't possibly do what these REITs do. So it's inevitable that we would need some on a macro and also localized. So 65-35 LTV, very strong, very healthy, totally okay with that. I mean, if he said 75-25, I'd say, yeah, I got an argument for something. 65-35, that's just healthy. Now, as we look into this, the single family sector, he says, the rental factor is exactly what recently Trump has banned with large scale institutions. Why? Because it's a great habit. You buy the house, you hold it, all of a sudden it appreciates. If there's tax incentives, or there are other things insurance-wise that you can blanket portfolios on, make those costs less, it's only more attractive to the owners. So why wouldn't they do that? I couldn't understand and agree more why they would. I also see the other side of the coin, which would not want people to do that on the macro level. I totally get that. Who the heck wants to have the 10 houses to the left of them owned by BlackRock? Right? I don't. Nobody else does, of course, but it's happening. Now it's disguised as rentals and families and things like that. But the reality is that's the case. So if you are diving in, depends on what side of the fence you are on. Now, I do find it appropriate, and I also understand why people wouldn't want it. So where you're at, I'm not sure, but that's a really, really good one to hit on that with these rates. Real Estate Rewired Live Weekly, top 3 stories, reaction videos. Have a great day. Thanks for chiming in.